I've seen the record button. All right. So let's take it again before we do
Okay.
our mental analysis, please. Let's take it again. Hide the floating. Chance. Okay. So here we go. All right. So let's take it one more time. Now let's put in the US dollar index because remember gold. We're looking to value gold against the US dollar and the treasury bonds. So let's put it here, which is real interest rates. So now it's very similar as you can see here. Looking at the 4-hour chart, let me go back again to a daily chart to take this and see why we are the essence of doing this. Now, this is the daily time frame on gold, right? From here, we had a one-way street, barely any pullbacks on the daily time frame for us to
Yeah.
have gotten into or scaled into this move. Now, how are we going to manage? Like, how do we feel we can be able to get into moves like this, which would potentially still play out again? Because I'm looking at gold from 4,500. My target on gold 4,500 and 5,000. I think gold might even hit 5K this year. Next year, sorry. Now, will there be pullbacks at some point? Of course, yes. Of course. There can be. Because like I said, there's many factors that drives gold. Federal debt is rising. Inflation has started cooling off, giving the Federal Reserve more room to cut interest rates. The labor market is weakening, which is there's downside risks to their dual mandate. All these things taken together, and also Trump appointing a new Federal Reserve chairman who he says would have to consult with him before making decisions. And Trump personally wants interest rates as low as 1%. So all these things are very bullish catalysts for gold. Now, how do we get moves like this? How do we get into moves like this? This is where we go into a 4-hour time frame. All these white lines were areas where we got undervalued for the dollar or the treasury bonds or both of them combined. Now, what you will see here is sometimes the treasury bond might come very close to getting undervalued, but the dollar might be undervalued. So amongst the two, if we get one, we take. All right. The treasury bonds, which are interest rates, are in the white line,
Yeah.
and the dollar is the purple. Let me let me just put in the dollar for clarity's sake. So we're looking at the US dollar valued against gold. Lower time frame 4 hour. How do we catch one-way streets like this? Here we came really close to being undervalued here. Here. It would have this wouldn't have been a trade. Here we got notice a lot has changed a bit. Here we got undervalued. Let's say you bought somewhere around here with your stop loss below this pivot. Boom. Sorry, below this swing, this lower time frame swing. This would have been a very good trade to the upside. The next undervalued reading was this one. Let's say you bought here with a stop loss below here. You didn't get stopped out. This was a nice trade. Another one is here, undervalued readings. Let's say you bought here with a stop loss maybe here for me personally, or maybe below lower time frame demand zones or this whichever way anyone chooses to place their stop loss. This was also a profitable trade. Here, you got undervalued here. All right. Let's say you bought here. Also, nice trades to the upside. Also, here you got undervalued. Let's say you bought here with stop loss. A stop loss would have been here or here. Also, nice trades to the upside. Uh, Another undervalued readings we saw was this one. This one here. Doing this on a 4-hour chart, we'll be able to scale into moves where we don't see pullbacks that much on a daily time frame. Just like where we have a lot of bullish catalysts, like we're going to have also going into 2026. Or got undervalued here. If you had bought this, this would have been your first loss as prices rolled over and got undervalued up close to getting undervalued here again. Now, if you had bought this undervalued readings with stop loss below this swing low here, this trade rolled over, started making lower highs, and didn't get undervalued or overvalued, which is a nice thing to see, and it shot straight up to the upside. And the next undervalued reading is here. We had bought somewhere around here with a stop loss below this swing. Prices rolled over again to the upside. Profits. Okay. And this was the next undervalued readings we got, which was Tuesday last week. Here. On a 4-hour time
Yeah.
frame. I'm not doing this on a 1 hour. I can still look at the 1 hour later, but let's just look at the 4 hour because I ran the hypothesis or the test on a 4-hour time frame. Now this is a 4-hour time frame. We got undervalued. Let's say you entered here at the close of this candle with the stop loss below this swing, or maybe for day trading sake, the stop loss below here. You rolled over, went sideways, and broke out impulsively to the upside. Profit again. So we've got like 2 to 3 losses or 2 losses thereabout, with the rest of the trades being profitable. Now, let's filter these trades for confirmations using technical analysis that we use, which is supply and demand. Doing rally-based rally, drop-based drop, etc. Let's go back from the beginning. Let's take it again one more time. Um, there's no demand zone here, so this one is out of the picture. Demand zone was here. We didn't come to the demand zone and prices rolled over without us. There's a demand zone here. If you had entered this trade, you would have gotten triggered. One prices came to the demand zone while being undervalued. And where would your stop loss have been? Of course, we both know our stop loss would be below the swing low. It came really close to our stop loss and rolled over again without stopping us out. And notice how we always go impulsively when we hit nice demand zone. And the next demand zone was here. Like I said, I don't want to make this analysis perfect. I want to make it rough. Usually on a lower time frame, we like to take the bodies of the candles because here we have a nice demand zone. We have two demand zones here. This is a rally base. Notice the wicks of this candle are longer than the bodies of the candle. These two red candles. We have a basing candle here and the leg out. So this is a demand zone. As well, here we have a rally. We have a basing candle here. And the wicks of this candle, and notice how smaller they are compared to this one and this one.
Yeah.
So this is a demand zone as well. Now let's see if there's another demand zone above. Let's say we're tracking price as it's going higher. So rally, base, rally. We'll have another basing candle in between these two. Demand zone. Usually we'll take the bodies of the candle, but let's take the wicks. I want to make this analysis as rough as possible. Stop loss below the swing of the demand zone for day trading purposes. But if this was a swing trading purpose, we'll have a level on top of level, lower time frame. I would have my stop loss somewhere around here for swing trading. But let's just say stop loss was here. Prices came really close. We didn't get stopped out. It accumulated. Now notice, and next thing we saw was big buys through to the upside after hitting the demand zone. So I think we have two demand zones now that were hit, right?
Yeah.
We have two trades that were in profit, and each of them hit more than 1 to 3. This was the first one here. Of course, this is more than a 1 to 3 risk to reward ratio. Also, this one as well here is more than a 1 to 3 to the upside. We don't want to measure that. We just want to measure how many trades we have winning and losing trades. So we have two winning trades using supply and demand in confluence with 4-hour valuation to filter out short-term trades and all that. Okay. I will still treat if you want to go down to a lower time frame to find further entry confirmations. I will still look at that, but that's strictly on you as the user. But if we are following this strategy strictly, we're just looking for 4-hour demand zones and lower time frame undervalued readings to scale into big moves. This is a leg in drop. This is an explosive candle, explosive red candle to the upside. We have a beizing candle here. Some people will call it a hammer. Yes, but still a beizing candle, longer wicks and smaller bodies. We have a decisive green candle, beizing candle, decisive green candle, and pullbacks. This was where we got undervalued. Now we had already tapped into this zone whilst we were below the zero line. At some point, you would have decided to take a trade here, maybe. But let's just say, for the sake of the analysis, you took this trade and you wanted to see what would happen. You started seeing something like this, and it's saw undervalued. And let's say you didn't even take this one, took it somewhere around here, and your stop loss was below the swing. Let's be very specific with our analysis. This was where you entered. This was where your stop loss is. Did you get stopped out? Of course not. You didn't. Price is actually rallied through to the upside. Now, where is our next reading? Using supply and demand. Using supply and demand. Remember what I said earlier, there's no clear demand zone here. The only clear demand zone we have is this one. So we'll have a drop, we'll have a rally, base, rally, and price is pulled back and we got undervalued here. Now, looking at zones like this, usually we tend to take the body of the candle, maybe here. But in this situation, let's just take the wick of this candle, making the analysis as rough as you can get. And where would you have placed your stop loss for day trading sake? You'd have placed your stop loss here. But for how it's supposed to be, your stop loss is supposed to be below the swing low, which is here. And prices came really close to the swing low, didn't stop you out and rolled over again. Now we have four trades in profits using supply and demand. Where else did we get undervalued? We go undervalued here. Is there any demand zone? Is there any demand zone I can find? Yes, there's one here. Where would your stop loss have been? You got triggered here, and your stop loss was here. The market eventually slightly moved to the upside. Your stop loss would have been here for day trading sake. Again, let me take it for day trading sake. And for swing trading, you want to place your stop loss below the previous swing, which is ideally the perfect thing to do or the best thing to do because you don't know how deeper the market might pull back. Right? We're just trading probabilities. Trading is a game of probabilities. You just want to stack a lot of them in your favor. So here, Ket gave you a one-to-one probably, and then rolled over. Let's just say we don't want to talk break even. We're talking winners and losers. We have four winners. This was our first loser here, this one. Market came to where you had your stop loss here, stopped you out, and got undervalued. Now let's go to the left to see if we can find any demand zones while we were getting undervalued readings. We have drop, base, rally, we have rally, base, rally. We'll have a demand zone here. For the sake of the analysis, making it look as rough as possible, we use the wicks of the candle. Usually we take the bodies, but let's use the wicks. Okay, you got triggered here. Where would your stop loss have been? For the sake of swing trading, again, the stop loss would be somewhere around here, below the swing. For the sake of day trading, the stop loss will be somewhere below this demand zone, here, or below the candle itself. We'll have two indecisive candles, so stop loss will be here for the sake of day trading, short-term trading. Entry, stop loss. Entry and stop loss. So you didn't get stopped out here. You didn't at all. In fact, the market came close but didn't stop you out and rolled over. Now, let's look for another undervalued reading. So after not getting stopped out, prices gave you profits, which at some point any wise person would have taken profits on this one. So you got undervalued here again using this demand zone. For the sake of the analysis, day trading stop loss would be here. Swing trading stop loss would be below the swing here. So for day trading sake, stop loss here, entry here, stop loss here. Didn't get stopped out. In fact, prices triggered you, pulled back, came back to your entry, and then rolled over and rallied impulsively. Started going sideways again. This was the next place we got undervalued here. There's no clear demand zone. Just buying the undervalued reading alone, market rolled over and started moving higher. So using undervalued in conjunction with supply and demand on a lower time frame 4 hour when there is a bullish higher time frame and also a bullish macro context. Remember, the technicals is a graphical representation of what is going on behind the scenes.
Yeah.
So the technicals are not really, it's not really what is driving what is going on behind the scenes. It's just representing what is going on behind the scenes. So we need to know what is going on behind the scenes first, even before touching technical analysis
Yeah.
to be on the safe side. So the green um the green zone you're seeing here is the previous all-time high for gold. Let me see if I have it. Yeah. So I was anticipating the break and retest. So we're currently sitting at overvalued readings. If we get a pullback at some point, if we get undervalued readings on the lower time frame 4 hour, that would be a good area to take buys. But personally, I like this area. I like this place. So using our supply and demand confluence again, let me take everything off here. Using so shit. Um, all right, vertical. Let me take off all the vertical lines, horizontal lines as well. Now let's mark the perfect supply and demand zone on the lower time frame 4 hour. This is a demand zone. Yep, buddy. So ideally, my here we have the proximal and the distal line. So my analysis or my thought process is this. If you want to buy here, you can buy here and have your stop loss. Buying here, buying somewhere around here or here would only guarantee giving you a wider stop loss. You understand?
Yeah.
Moving forward, with what we're seeing right now in gold. But if you want to reduce or increase your profit margin, you can buy maybe somewhere around here, or you can just buy at the 4 hour zone and have your stop loss below the previous swing. Like I said, what should be our target? Remember, institutions are targeting 4,500. This is 4,500 for gold. Oh, well, yeah, 4,500. What's the risk to reward ratio? If you're using the demand zone here, it should be 3 hours, 1 to 3 risk to reward ratio. Now, like I said, our risks should be relatively small, but it should be very small when using this lower time frame approach. You should risk somewhere around 0.5% of your account maximum. If you want to be really crazy, you can go 0.6%. But you risking a
Yeah.
whole 1% on this strategy, even how far we've seen the profitability compared to the losses, because obviously we had more profits than losses, but still, keeping the risk should be small. The risk size should only increase when you have a higher time frame opportunity of seeing undervalued and also COT still being bullish. That is where you can take trades with 1%, 2%, because you have a more bigger confluence, right? And also Euro USD, we're going to use the same thing on Euro USD. I don't know, it failed to come back into the demand zone. It's going higher because remember, I think I told you, I said non-commercials, hedge funds made a higher high. Looking at the COT index that we use, the indicator we use, they made a higher high, and we're expecting euro dollar to also make a higher high. So our thought process was it was going to come back to that demand zone, which it didn't come back to, and it's actually printing green candles. Last time I
Yeah.
checked, yeah. So on gold, this is my analysis. So like I said, If you want to buy here, you can buy. If you want to buy at this demand with your stop loss here, you can buy. Buying here or here really increases your area, like your area of stop loss. It increases the room and reduces your profit, like your profit margin. So if you're initially looking to take a 1 to 3, maybe somewhere around here would give you a 1 to 2, which is not bad actually, or 1 to 1. So what it does is buying around this green area high here would give you a lower profit margin. Buying around here will give you slightly lower profit margin as well. But I think definitely this should be more than a 1 to 2 from here to here. But if you're buying here at the proximal line, you have a 1 to 3, getting 4,500. But personally, looking at what I just told you, what we just talked about, new Fed chairman, 1% interest rate, consulting with Trump before making decisions, inflation going lower than, inflation printing lower than expected. All these things combined, federal debt rising, interest rates reduction, all these things combined is very bullish for gold. So personally, I think we
Can't really
might
see it
see,
pulling back.
huh?
Can't really see it pulling back that far.
Yeah. So I think we might see a $5,000 gold next year. So from a swing trading perspective, a 4,500 is the target for the near term. For the longer term picture, I think gold might hit 5K. Uh, This is actually doable. I mean, look at what has happened for the rest throughout this year. And
Yeah,
2026 is a midterm election year. 2027 is an election year. So midterm election is also bullish for gold and bearish for the dollar. So
yeah,
I think gold is hitting 5,000 by next year. Can be next year
got
end,
there.
it can be next year, fourth quarter, but definitely 5,000 is doable for gold
Yeah,
before 2027. All right. So, but for now, our target should be 4,005, 4,500.
it could hit that tomorrow.
Yeah,
Where it's going.
it could do that. The way it's going, it could do that tomorrow. That's how bullish it is. So our target is 4,005 short term. Longer term target, 4,000, 5,000 is doable. So we'll be looking at it on a 4 hour time frame. If we get all those undervalued reading setups like we got earlier, like we just looked at all these type of setups, then we
Yeah,
can look to take trades on gold and not risking a large sum of our account. Because like you saw where we took 2 losses in a row, right? So
yeah,
you can take 2 losses in a row and only losing 1%. And when you're using risking 1% and you have 2 losses in a row, and maybe that might have been your first trade. Because like I said, I don't really like hindsight. I like forward testing. Maybe forward testing, the first trade using the strategy might be your first loss. So you have to minimize your risk and divide it
yeah,
into two, yes. So if your first trade is a winner, second trade a winner, then you can increase your risk as you go. There's nothing bad with that. All right.
yeah,
Yeah. So if you have a first trade 0.5%, you won 3 hours. That's you made 1.5%. You take another trade, you make 3 hours. You've made 3%. So with that 3%, you can say, okay, I want to risk 1%. Even if I lose the 1%, I'm still up 2% in profit. And if you
yeah,
take 1% and you make 3%, you have 6 hours, which is 6%. Now you can say, okay, I want to risk 1% again. And you can equally make 2 hours, 4 hours, who knows? So that's the
yeah.
start small and reduce your risk as you take losses. Okay. So this is
Yeah.
this is the idea. Pullbacks we enter. Under pullbacks with or undervalued readings we can enter. All right.
Okay.
Yeah. The small risk,
Cool.
small risk size, very important. Now, let's look at the fundamentals. I'm really, really pained by Euro USD. But what can I say? Can I say or do? Same thing. Well, the same thing. It also works on currency pairs, to be fair. It works on currency pairs. I mean, you can see it works on currency pairs, but yeah, undervalued 4 hour, but I prefer gold. Gold is bullish. Currency pairs tend to they pull back a lot.
Yeah.
But gold and silver is one-way street. I mean, if you look at the same analysis we just did on silver, you can see how crazy these things are. Look at this. Undervalued 4 hour time frame rallies. Undervalued again, rallies. I mean, crazy. Undervalued here. Straight shot to the upside. Undervalued here. I mean, if you start connecting supply and demand zones, I mean, this is crazy trades here on silver and gold. Undervalued here, rallies. Undervalued here. Maybe you would have taken a loss here, but this would have paid for it. This would have paid for it. And this one alone would have paid for it. Even this one would have paid for it. So these things are mad. Like, look at this undervalued upside. Here again,
Yeah.
upside. It's just crazy. And if you go up back, if you go out to a high time frame daily, you barely get pullbacks on this thing. I mean, look, there's just one pullback. I think I traded this thing, but I traded it on a practice account at the time. I don't know if you remember. I was able to catch this wave to somewhere around here. I closed out. It continued going higher. Crazy.
Yeah.
Using the 4 hour time frame and valuation metrics, you would still be able to catch all these red candles as undervalued readings, and they have been able to scale into these moves, just ride the wave and all that. So the same thing here. I mean, look at this. Look at how do you trade this? Breaks out, boom. If you were expecting
Yeah.
a test, no retest, it just continues straight. The only thing you can do is just to go down to a 4 hour chart, find undervalued readings, and join the trends. So, as much as we've already established our bias for gold, Abi, our technical analysis for gold. So, we also do the same for silver. So, we have a 4 hour break, and did we retest it? No, we didn't. It was close. So, we broke this resistance level, now becomes support. Using supply and demand, we have a demand zone here. There's another demand zone here. So, there's two demand zones. 1, 2. So let's say we got to this one and we're not undervalued, automatically we're not going to take this one. But if we comes back lower, we're within this one and we're undervalued, or we hit this one and we're undervalued, then we can take a trade here with our stop loss here and anticipate silver to continue higher, which it is going to continue higher because there's a supply shock in silver recently. I don't know if you saw that in the UK news.
No.
Now, there's a supply shock. There's a shortage of supply of silver and copper, I think. But
Okay.
that's why you see silver outperforming gold aggressively. At some point, gold is going to catch up though. But yeah. So this is it. Now let's go to fundamental analysis. Let's see. Why did we say gold is bullish? Why did we say gold is bullish? I hope I'm recording this meeting.
Yeah, you are.
Let me check. Yes, I am. I am. Okay, so let's see if we can use Grok. I like using Grok because it's more logical than ChatGPT. So let's look at the US using the prompt we use for AI. Where is it? Okay. All right. Yeah, this one. Copy. Paste it here. All right. Let's put it here. Paste. Send it. Okay. Let's see. Let's see what we have there. Also, we missed those trades on the equities, like on stocks.
Yeah,
We missed it because we were waiting for undervalued readings, which the put to call ratio was actually signaling people were scared. People were buying put options. We would have leveraged on that, but okay, it's okay. It's okay to stick to your rules at least. At least.
yeah.
Sometimes it hurts and sometimes it saves you. But that's the truth. Who knows if we had gotten greedy and we took the trade because people were scared and buying put options. We wanted to make money from them being scared and he pulled back a bit. Would have lost that one. So, let's see. It's searching the web, gathering data to. So I think the question is very clear. We are trying to make the AI feel like a member of the FOMC, a voting member of the Federal Reserve, and that votes in determining the interest rate. So we said you are a senior member of the Federal Reserve with the analytical rigor of a world-class macro trader. Your entire framework is governed by the Federal Reserve mandate, and you are an expert at managing market expectation. Your task is to provide a concise 2 to 3 paragraph monetary policy assessment based on the most recent policy, publicly available economic data that matters for the central bank. Very key. Matters for the central banks. Now, what the AI is going to do is going to save us a lot of time from us going to gather data, put together data, try to analyze, look at forward guidance. It's going to gather all the data using thinking like a macro analyst. Remember, we said with the analytical rigor of a world-class macro trader, which is very nice. So, stated position, briefly summarize the sentiment from the latest statement of the press conference, which is what Jerome Powell comes out to say every FOMC meeting. Also, the AI is going to look at the primary risk and all that. So here, this is the result. It said, as a voting member of the FOMC, I draw on the latest data to guide our policy decisions in line with our dual mandate of maximum employment and 2% inflation. In our December 10th statement, we lowered the federal fund rate by 25 basis points, right, to 3.5 to 3.75%, reflecting a balanced view amid moderate economic growth. A softening labor market. Remember, I talked about the labor market being the point of
Yeah.
concern the Federal Reserve because there's downside risks to the labor market, no longer inflation. Inflation was back in 2022. Now it's down the labor market, which means they need to cut rates. And inflation that remains somewhat elevated, but shown progress toward our target. The vote was split, with some colleagues favoring a larger cut or pause, underscoring our data-dependent approach in the press conference. That is the chairman. Chairman Powell emphasized that risks to both sides of the mandate are now more balanced after our recent easing, but will continue monitoring incoming information closely without committing to a preset path, which means they will be data dependent. And remember, the data that started coming out after that was printing lower inflation. AI is also saying the same thing I just said. And I said, looking at the freshest numbers, the employment side of our mandate is facing the greater pressure right now. The November jobs report showed only 64,000 non-farm payrolls addition, well below trend, and the unemployment rate ticked up to 4.6%. This is bullish for gold, higher than our median projection, and 4.5% for year end. Meanwhile, inflation is easing, giving the Fed room to cut interest rates, also bullish for gold. Inflation is easing more encouragingly with November CPI, which printed at 2.7% year over year, and October core PCE. PCE is personal consumption expenditure. The Fed tracks this thing very, very well. Core PCE also eased at 2.8%, came down from 3%. Very, very good. both edging closer, you see, both edging closer to our 2% target goal amid solid Q3 GDP growth estimates around 3.5%. Also, the GDP growth is estimated to be around 3.5% for the US, which is also nice. This data broadly aligns with our forward guidance from the meeting, validating the recent costs, which is the recent interest rate reduction, as labor market risks have materialized faster than anticipated. But it also hints at potential downside for employment if growth slows further. As a result, I'm leaning dovish. Now, dovish means the central bank is bearish for their underlying currency, which is bullish for gold. I am leaning dovish here, ready to support additional easing if labor data doesn't stabilize to prevent unnecessary slack from building while inflation trends favorably. In terms of market reaction, this dovish tilt should weigh on the dollar medium term as traders price in lower rates ahead, diminishing the greenback's yield advantage, and shifting expectations towards a softer policy stance that eases financial condition. Now, how is this bullish for good? The yields here also something I wanted to talk about. Now, let's say you're a hedge fund manager, you're trading gold, and the dollar, if you buy and you hold the dollar is offering you a 4% yield. Remember, gold is a non-yielding asset. But all of a sudden, the central bank comes out and say there's something going on. We need to start cutting rates to support the economy. Maybe there's downside risk to the one of their dual mandates. It can be inflation is going down aggressively, or unemployment is rising aggressively. They want to start cutting rates. Now, cutting rate reduces the yield of that underlying currency. Now, the dollar being the reserve currency, which directly impacts the value of gold. So now, anytime the central banks become dovish when it comes to things like cutting rates or lower inflation, etc., this is very bullish for gold because definitely they need to cut rates. So
Yeah.
yeah. So now gold has a very bullish reading using macro analysis. Now the AI just analyze all this data as a macro analytic trader, right? So it's the AI has done all the heavy lifting for us right now. The only thing we need to do is go to the chart and find entries and exits. Simple. All right. We can also ask it, okay, we can say, how bullish is this for gold? How is Let's ask it, how is this bullish for gold? How is this, oh, sorry, let's just say, is this bullish for gold? Is this bullish for gold? Oh, sorry, question mark. Let's see. Let's see if we are right or wrong. Again, yes, you see, the AI says,
Yeah.
yes, this assessment and particularly the fresh November data we've just digested, is quite bullish for gold in the medium term. That was why I told you medium term we target 4,500. I'm feeling myself. So my dovish lean stems directly